So the earnings of the S&P 500 have been between this range of 10 and 20. We were just about to go over the 20, which is the high end of the PE range.
What's happening, guys, and welcome back to yet another great video on our channel. Investing in the stock market is a long-term strategy that helps you manage your money. Investing in the stock market can be intimidating because it appears to be excessively difficult. A thorough knowledge will assist you in getting started. According to Peter Lynch, the prospect of better returns on your investment and the development of financial discipline are two of the top reasons to invest in the stock market. Here is the ultimate guide to stock market investing.
To thank you for watching this video, we're offering you an absolutely free training webinar. Have you ever wondered how to end procrastination and self-sabotage so you can unleash your full potential to live the life you deserve? #1 best-selling author and high-performance coach Peter Sage is hosting a free webinar where he'll teach you how to increase your wealth with less time and struggle, and also how to hyper-boost your growth and success so you can finally break out of any rut you find yourself in. Right now, Peter and his team are offering a free $100 gift to anyone who doesn't find his webinar as the best use of their time within the last 5 years. Now, let's get back to the video.
Number 6. Cost of investment.
Fundamentally, we invest money in order to see it grow and make more money. That's what investing is all about.
A brokerage fee is paid to all brokers, which is the charge they get for arranging a deal on your behalf. These expenses are declining rapidly thanks to cheap brokers. They collect taxes and dues given to the government on each transaction, including the stock transaction tax or STT, SEC charges, and the goods and services taxes or GST, among others. Your broker or brokerage platform may open your demot and trading account on your behalf, but they don't manage it. To represent your property, demot accounts are maintained by central securities depositories such as NEFT or MCX, which are regulated by the government. To keep your account active, you must pay a small yearly fee, which is usually collected by a broker or brokerage platform. Taxes are a proportion of your investment profit that you pay to the government. If you keep stocks for more than a year, you'll pay a long-term capital gains tax of 15%, and if you hold for less than a year, you'll pay a short-term capital gains tax of 10%. Number 5. Stock categorization.
It gives us the total worth of the company on the open market, as well as market's perception of its future prospects.
The market cap, also known as market capitalization, is the total worth of a firm. Large caps are defined by SEBI as the top 100 stocks by market capitalization. These businesses are among the country's largest in terms of revenue, well-established, and typically market leaders in their fields. These are considered to be the safest investments, although they may not rise as quickly as mid or small cap equities. Mid caps, as defined by IBC, are stocks with a market capitalization of between $151 and $250 million. These firms are smaller than large caps, have stronger growth potential, and can disrupt or grow into large caps. They're regarded as riskier than huge caps, but safer than tiny caps. SEBI classifies all stocks in the top 250 by market capitalization as small caps. These are small company stocks that are frequently quite volatile. These are believed to be riskier than the other two, but they offer the potential for larger profits. It's said by Peter Lynch that knowing market cap is an important aspect. Number 4. Risk tolerance.
Risk is uncertainty that can affect the outcome of your project. And we often represent risk.
The amount of danger you can take depends on your risk tolerance. The investing timeline, age, aim, and capital are all factors that influence risk tolerance. Another thing to keep in mind is your present liabilities. If you're the primary breadwinner in your family, for example, you'll be less likely to take chances. Perhaps you'll have more debt and large cap stocks in your portfolio here. If you're younger and have no responsibilities, on the other hand, you may have a high risk tolerance. This may allow you to invest more in shares rather than loans. You may be able to invest more in small caps, which are riskier companies, even with equities. The first step is to make a decision, considering that risk and profit are closely linked.
To thank you for watching this video, we're offering you an absolutely free training webinar. How would you feel knowing that you could pay every bill you have right now as well as any future bills that come in? Commission Hero is a proven system that has helped over 8,000 people earn upwards of $1,000 a day or more. The best part is that there is zero experience needed to get started. In this free training, Robbie Blanchard and his team will teach you the top 3 secrets to how and why this system works, and how it can also work for you. Join the thousands of people who have found success and financial freedom using Commission Hero. Right now, the first 100 people to use the link below will get access to this free webinar. Now let's get back to the video.
Number 3, varying portfolio.
Spreading your risk. Now, to simplify this concept, I want to talk about it in terms of food.
Investing in a wide variety of assets is the basic rule for creating any portfolio, as there's a famous saying which goes by, don't put all of your eggs in one basket. This is because it reduces the serious effect if a new asset performs poorly. Diversification occurs across asset classes, businesses, and cycles. It's tempting to put all of your money into an industry that's on the rise. However, it's probably best to vary across industries, balancing market size exposure and hedging the risk of equity shares with stable but lower yielding bonds. Finally, make use of SIPs to ensure that you've invested in securities during various market cycles. As your goals vary over time, you'll need to adjust your portfolio accordingly. Every few quarters, rebalance your portfolio to ensure that you're neither over nor underexposed to any one stock or asset class. Number 2, steps to invest in the stock market.
You will need 3 basic documents: identity proof, address proof, and proof of date of birth.
On the stock market, you can't purchase or sell directly. You must go through a broker who is authorized to trade on the market or a stock brokerage firm that allows you to trade on their platform. The procedure is concise. You must first register a trading account with a broker or a stock brokerage platform to begin investing. You really trade or put buy or sell orders in a trading account. A depository account is opened for you by a broker or stock trading platform. The financial securities in your name are held in a daemon account. After that, your bank account is connected to these 2 accounts. You must supply Know Your Customer KYC paperwork, which includes verification via government-issued identity cards to create a trading and transactions account. Most brokers and brokerage platforms now feature an online authentication procedure that allows you to create an account in a matter of days by electronically providing your verification information. Once your account is created, you may trade with your broker or brokerage firm online through a portal or over the phone. Number 1, types of stock.
When you think generally about stocks and their attributes, you are likely thinking about common stock.
Equity shares are issued by businesses and entitle you to a share of the company's profits in the form of dividends. Bonds, which are issued by corporations and governments, are loans made by the investor to the issuer. These are issued at a certain interest rate and for a fixed period. As a result, they're also known as debt or fixed income instruments. MFs are vehicles for pooling money that is later invested in various financial products. They are issued and administered by financial institutions. The profits from the investments are divided among the investors in proportional to the number of units or investments that they own. They're referred to as actively managed products, in which a fund manager makes decisions on what to buy and sell on your behalf to increase returns. Funds, which are becoming increasingly popular, simply track an index such as the Nifty or the stock market. When you purchase a unit of the ETF, you're purchasing a portion of the FTY's 50 stocks at the same weighting as the FTY. These are known as silent products, which are generally less expensive than mutual funds but have the same risk and return profile as the index. The value of a derivative is determined by the performance of an underlying asset or asset class. Commodities, currencies, stocks, bonds, market indices, and interest rates are examples of derivatives. So do give us your thoughts regarding all of this in the comments down below. If you enjoyed the video, do smash that like button to show us your support, and if you want more content like this going forward, Then don't forget to subscribe to our channel and hit that bell icon. And as always, I'll catch you guys later in another video. Bye now.